You know what drives me absolutely crazy? Watching people throw their hard-earned money at the stock market like they are feeding coins into a slot machine while completely ignoring the fact that they have credit card debt charging them 22% interest sitting right there laughing at them. It is like trying to fill a bucket that has massive holes in the bottom and wondering why you are not making any progress. Most people treat investing like a shopping spree. They buy a little bit of cryptocurrency because their friend told them to. They buy a trendy exchange-traded fund because they saw it on the news. They open a brokerage account because they want to feel like an investor. But they are skipping the boring foundational work that actually makes the math work. Imagine you are building a house. You would never start by picking out fancy light fixtures and granite countertops if your foundation was cracked and your roof was leaking. Yet that is exactly what most people do with their finances. They get excited about the decorations while the structure is collapsing. The consequences of getting this order wrong are not just minor inconveniences. We are talking about hundreds of thousands of dollars in lost wealth over your lifetime. Every month you delay paying off high-interest debt is a month where that debt is growing faster than almost any investment you could reasonably expect to make. Every month you ignore your employer match is free money you are setting on fire. And every month you contribute to a taxable investment account before maximizing your tax-advantaged options is money you are unnecessarily handing over to the government. Today, we are going to fix the foundation. We are going to walk through the exact optimal sequence for allocating your capital. This is not about picking stocks. It is about financial architecture. If you follow this blueprint, you stop bleeding money and start building a fortress. Before you invest a single dollar in the stock market, you need to establish a perimeter of safety. We have discussed the $20,000 milestone before as the ultimate goal for peace of mind, but you have to start somewhere. The first step is the emergency fund. I know this sounds boring. I know you would rather hear about which tech stock is going to double next week. But here is why this matters more than you think. An emergency fund is not just about having money for unexpected expenses. It is about creating a psychological safety net that prevents you from making terrible financial decisions when life inevitably throws you a curveball. When your car breaks down or you face an unexpected medical bill, having an emergency fund means you do not have to sell your investments at the worst possible time or rack up high-interest debt to cover the expense. It protects your long-term strategy from short-term chaos. Recent research from Vanguard found something fascinating. People with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than those without any emergency fund. That was the largest boost linked to any financial factor they measured. $2,000 is not life-changing money in terms of purchasing power, but the psychological impact of having that buffer is enormous. Start by saving your first $1,000 as quickly as possible. This covers most minor emergencies like a blown tire or a minor home repair. Then work toward 1 month of living expenses. Once you hit that milestone, keep building until you reach 3 to 6 months of expenses. This creates the bedrock. Without this, everything else you build is standing on quicksand. Once you have your basic safety net in place, we move to the mathematical non-negotiables. This is where most people get confused because there is a specific exception to the rule about paying off debt. If your employer offers matching contributions to your retirement plan, you should contribute enough to get the full match, even before you finish paying off high-interest debt. This might seem counterintuitive, but the math is compelling. Employer matching is essentially a guaranteed 100% return on your investment instantly. Even if you are carrying credit card debt at 22%, getting a 100% immediate return usually makes sense. It is like finding money lying on the ground that your employer will double if you pick it up. If you earn $50,000 annually and contribute $3,000 to get a $1,500 match, that is a 50% immediate return plus whatever your investments earn over time. No other investment opportunity in the world guarantees that kind of return. But once you grab that match, you must immediately pivot to killing the enemy. I'm talking about high-interest debt. Anything charging you more than about 8% annually is financial cancer. Credit card debt, with average interest rates over 22%, destroys wealth faster than you can build it. Carrying credit card debt while investing is like trying to run a marathon with a backpack full of rocks. Mathematically paying off debt with a guaranteed high interest rate provides a guaranteed return equal to that interest rate. If you have $5,000 in credit card debt at 22% interest, every dollar you use to pay down that debt is essentially earning you a guaranteed 22% return. That is better than Warren Buffett performs in the stock market. Use the debt avalanche method. List all your debts, pay the minimums on everything, then throw every extra dollar at the debt with the highest interest rate. This is the most mathematically efficient way to get out of the hole. Now that you have secured the match and killed the toxic debt, you enter the tax optimization zone. This is where the wealthy separate themselves from the average investors. And the most powerful tool in this zone is one that most people completely ignore: the Health Savings Account, or HSA. If you have access to a high-deductible health plan, the HSA is not just a savings account for doctor visits. It is the Swiss Army knife of tax-advantaged accounts. It offers a triple tax benefit that is unmatched by any other vehicle. First, you get a tax deduction for contributions just like a traditional retirement account. Second, your money grows tax-free while invested. And third, and this is the kicker, withdrawals for qualified medical expenses are completely tax-free, even in retirement. It is the only account that gives you tax benefits on the way in while it grows and on the way out. Here is the advanced strategy that makes this incredibly powerful. If you can afford it, pay for your current medical expenses out of pocket using your regular income. Let your HSA money stay invested in the market, growing tax-free for 20 or 30 years. Keep all your medical receipts digitally because there is no time limit on when you can reimburse yourself. You could pay for a doctor visit today, keep the receipt, and reimburse yourself from your HSA 20 years from now tax-free, after the money has had decades to compound. After age 65, you can withdraw money for any purpose, just like a regular retirement account, though you will pay taxes on non-medical withdrawals. But given that the average couple will spend hundreds of thousands of dollars on healthcare in retirement, having a tax-free bucket for those costs is a cheat code. After the HSA, the next step in the sequence is often misunderstood. Most people think they should just put more money into their workplace 401k. But the optimal move is actually to look at an individual retirement account, or IRA, first. Why prioritize the IRA over the 401k once you have the match, control, and fees? Corporate 401k plans are notorious for offering a limited menu of expensive mutual funds with management fees that can eat into your returns like termites in a wooden house. With an IRA, you can invest in low-cost index funds that charge fees of just a few basis points, instead of the 1 or 2% fees common in many employer plans. That might not sound like much, but over decades, those fee differences can cost you tens of thousands of dollars. It is the difference between keeping your money and slowly feeding it to fund managers who drive nicer cars than you do. For 2025, you can contribute up to $7,000 to an IRA. You also have to choose between traditional and Roth versions. If you are young and in a lower tax bracket, Roth is usually the winner because you pay taxes now on the seed, so you do not have to pay taxes later on the harvest. Once you have maxed out your IRA, then and only then do you go back to your employer 401k and start contributing beyond the match to fill up that bucket. The limit is $23,500 for most people. If you can fill the HSA, the IRA, and the 401k, you are sheltering massive amounts of money from the government every single year. Finally, we get to the step where most beginners try to start: taxable investment accounts. This is the wild west of investing, where you can buy individual stocks, trade options, or buy crypto. But in the optimal architecture, this is the absolute last step. Taxable accounts are flexible, sure. You can access the money whenever you want, but they suffer from something called tax drag. Every dividend payment gets taxed. Every time you sell an investment for a gain, the government wants their cut. It is like running a race while someone keeps throwing sand in your shoes. The difference in returns is staggering. Let us say you invest $10,000 annually for 30 years. In a tax-advantaged account earning 7%, you end up with about $944,000. In a taxable account, with the same return but paying taxes on dividends and capital gains along the way, you might end up with closer to $700,000. That is nearly $250,000 difference just from tax drag. You should only be investing heavily in taxable accounts if you have already maximized your tax-advantaged space, or if you are specifically saving for a goal that is less than 5 years away, like a house down payment. So there you have it. The optimal sequence for financial success is not a mystery, and it is not a matter of opinion, it is a matter of math. First, build the psychological fortress with an emergency fund of at least $2,000, initially growing to 3 to 6 months of expenses. Second, take the free money from your employer match. Third, attack the financial cancer of high-interest debt with the avalanche method. Fourth, optimize with the HSA, the triple tax threat. Fifth, minimize fees with an IRA. Sixth, max out the rest of your 401k. and seventh, only then enter the taxable markets. This is how you turn the gap strategy we discussed previously into a wealth-building machine. You create the gap by earning more and spending less, but then you must direct that capital through this specific sequence to ensure it is not being eaten by interest, fees, or taxes. If you follow this order, you are not just investing. You are engineering a financial life that is bulletproof. You are moving from playing checkers with your money to playing three-dimensional chess. Stop looking for the next hot stock and start building the architecture that makes wealth inevitable.